Hi traders, you're welcome back to the Forex Geek channel. If you've ever wondered why price suddenly reverses right after you enter a trade, or why stop losses keep getting hit before the real move happens, then you are about to uncover the secret behind market liquidity. Okay, this is how smart money moves. And in this video, I'm going to break down the liquidity trading strategy so you can trade with the big players instead of trading against them. Okay. I'm just going to be showing you how liquidity shapes price movements, how to spot liquidity pools, and how to use this knowledge to improve your trade entries. All right. But before we get started, make sure to smash that like button and subscribe for more high level trading strategies. All right, let's just dive right in. Now, liquidity is the fuel that drives the market. Okay, it refers to the availability of buy and sell orders at different price levels. All right, so when there is high liquidity, orders get filled easily and price moves smoothly. On the other hand, when there is low liquidity, price can become erratic, leading to sharp spikes and stop hunts. Okay, but here's the key: the market is constantly hunting liquidity. All right. Institutions and smart money look for areas where a large number of stop losses and pending orders are sitting. They push price into these areas to trigger liquidity before making the real move. Right. So if you don't understand how liquidity works, you keep getting trapped in fake breakouts and stop hunts. All right. I'm just trying to see if we can find an example of, perhaps a fake breakout. Okay, you can see we had something around here. You can see that this was, a resistance zone, right? And you can see what happened here. You can see that we had a, you can see that we had a fake breakout around here. Now, if you had rushed into entering a buy trade, well, you would have lost money because the price, eventually turned back down. So in such situations, it could be, it could be that perhaps there was stop hunt, as a result of the activity of smart money or institutions and all of that. It could be, okay. And in order to avoid getting trapped in stop hunts or fake breakouts, then you have to pay attention to understanding liquidity and understanding, price action. Okay. Now, if you master liquidity, if you understand how it works, you will know exactly where price is likely to move next. So where does liquidity build up? There are three main areas. uh, Swing highs and swing lows are one of them, right? Swing highs and swing lows are one of the areas where liquidity builds up. Now, when you have swing high, right, swing low, and so on, right? Swing low, swing low. So swing highs and swing lows are areas where liquidity can build up. Okay, these levels act as liquidity magnets. Then we also have support and resistance zones. You can see this one I identified here. It's a resistance zone, right? We have support and resistance zones. They are another significant area where liquidity builds up, right? The more times price bounces off a level, the more liquidity builds up there. So smart money often manipulates these areas before the real move happens. Then another area to watch out for are big round numbers, psychological levels, what we call psychological levels. Levels like 1.1, 1.2, 1.3. For example, if you're trading the euro USD, if price is around maybe 1.1000, maybe 1.2000, 1.3000, and so on, forex often attract liquidity. Those areas, those prices often attract liquidity because traders place orders at these obvious price points. All right, now a key takeaway is that liquidity pools are where price is likely to make a sharp move. So instead of getting trapped, we can use these areas for high probability trade setups. Now smart money often creates false breakouts to trigger liquidity before pushing price in the real direction. So this is called the stop hunt. So here's how it works. The market moves toward a key level where retail traders have stop losses. It then spikes beyond that level, taking out stops and triggering pending orders. Once liquidity is taken, the market reverses and moves in the intended direction. Okay, so how do you use this to your advantage? Instead of entering at obvious levels, wait for a stop hunt and look for a strong reversal signal. All right, wait for a stop hunt and look for a strong reversal signal before entering in the direction of the real trend. Okay, then also use candlestick confirmations like like the bullish or bearish engulfing patterns, or a pin bar after liquidity is grabbed. Okay, so let's just break this down even further. Now, for an entry strategy, you should identify a liquidity pool near a major swing high or a swing low or support or resistance zones, right? Then you wait for a liquidity grab, okay, a quick spike beyond that level that triggers stop loss. Then after that, you look for a rejection, a strong rejection candle. You can see this bearish candle. You can see how strong it was. So you look for a strong rejection candle or any price pattern that confirms the reversal, okay? Then after that, you can enter a trade in the direction of the real move. In fact, you could have even decided to wait for more candles to form. Okay, it doesn't mean that just after the first candle, then you should jump in. Wait for more candles to form. Then, you would have noticed, kind of an ascending wedge pattern forming around here. You can see that we have, an ascending wedge pattern forming. So after this ascending wedge pattern was broken, it would have been a good place to enter a sell. It would have been a good place to enter a sell, okay? Now for your take profit, your first target could be the next level of liquidity, okay? The next level of liquidity, which is going to be, around this level, right? Around this level will be your next level of liquidity. You can see that we have a support zone around there, okay? Basically you can just use market structure, just target, key levels for your exit. Then that's for your first target though, because this is the next significant level. Then your second target, you can just let the price to run, and then trail your stop loss for extended moves. All right, now this strategy helps you to avoid getting trapped and allows you to enter trades with precision. Okay, now some common mistakes that traders make include chasing the move. All right, if you enter before liquidity is grabbed, you will likely get stopped out, so always wait for confirmation. Okay, and secondly, do not ignore market structure. Liquidity alone is not enough. Always combine it with trend analysis. All right, make sure that you have analyzed the trend. The prevailing trend, is the trend up in the upward direction? Are we having a consolidation? Are we having a consolidation? Ask yourself, those questions. And then, once you have done that, ensure that you always get confirmations before entering a trade. Now, with respect to placing stop losses in obvious spots, do not do that, okay? Because of stop hunts. If your stop loss is placed where everyone else's is, it's likely to get hit. So use hidden stop placement beyond liquidity zones. All right. So instead of putting your stop just immediately above this resistance, you can send it some pips higher. All right. So master these principles and you'll avoid common retail trading traps. Now, if you found this video helpful, hit that like button and subscribe for more powerful trading strategies. Comment below, have you experienced stop hunts before? Let me know your thoughts. Turn on notifications so you never miss an update. Happy trading, and I hope to see you in the next video.